to 12:30 p.m. Eastern time. Okay, that's not what I'm talking about here. Okay, you can make this more specific. So you can look for the sweet spot from, we might as well say it from 2 to 4 a.m. That's one option. And then you can look between 9 and 10 a.m. And then you can look between 11 and 11:30 a.m. Now what might wind up happening is you come in at 9 and you see that the market, like here, you can see that coming into the market before 9, that it looks like there's a setup. So you may sit there for a little while. Or back here yesterday, where the market at 9 o'clock was still going down and it didn't really start to reverse until about 10 o'clock. Again, you may be sitting there. And you may decide to come back in every 10 or 15 minutes and take a look at the screen and see what's going on. But the main thing here is that it's the sweet spot. That's the most important. And the idea here is that if you don't have this one thing, then you're not even looking for a trade. And I'm telling you, back when I was first learning to trade in the mid-90s, this concept of the most important to the less important items on my checklist, it saved me a ton of time. It meant that I could track a bunch of different symbols. In fact, I think at one point I was tracking 90 different stocks at any one time. And it's because I could do this. If I would look at one or two things, and if those two things weren't there, I didn't have a trade. Okay? So we've got the sweet spot hours. Number 2. This could be pattern. Okay, so, is there a triangle? Is there a flag? Is there a pennant? Okay, all of these things. But also you've got, is there a little dipper? So what do we need to see for that? We need to see that the market, for a little dipper, we need to see the market has made a move down, has made a sharp move up and down. So remember, it's 1, 2, 3. It's got 3 different parts. The market has moved down, it's moved up quickly, and it's moved down quickly. That is a picture perfect little dipper. And the reverse applies for the short. It would be if the market moves up, moves down quickly, and then back up. Okay, so 1, 2, 3. It could be a sneak attack. A sneak attack where the market just makes it makes a move up, and then a very quick move down, penetrating the last low. Or if the market has made a move up, where the market makes a move down and then boom, pushes up past the prior high. So number 2 could be market pattern. And yes, you do want to identify the different patterns that you're looking for. Triangles, flags, pennants, double tops, triple tops, trading lanes. All of that goes into that. All of that goes under the whole heading of pattern. Then 3 would be trend. And you can see these are main points where really if we had a whole checklist out, we'd have one sweet spot and then 1, 2, 3 listings under it. Pattern, we'd have, triangle, flag, pennant, double top, triple top, little dipper, sneak attack. So there's 1, 2, 3, 4, 5, 6, 7. You see? So there's more detail that you can put in this. And this is something that you could type out, put it on a sheet of paper, make a bunch of different copies, and every trade, have this sitting there in front of you. Now, and I'll talk about trend, and this is the last thing, because these are really the 3 main components. So then trend, what do we have? We have the hourly, the 4-hour, and the daily. And if you wanted to, you could even put in the weekly here. But that's not as important as the daily, 4-hour, and hourly. So now we have to look at where is the trend. And remember,